Hello and welcome. After the everything rally in the last quarter of 2023, when both equities and bonds were up in aggregate, markets have begun the year slightly more subdued, with some down year to date. Much of this is related to inflation and the policy rates of various central banks, two factors that have been front of mind for market participants, consumers, and households for some time. Starting at home, in the UK last week, we saw a slight rise in the level of consumer price inflation, with year-on-year numbers rising from 3.9% in November to 4% in December. This lowered market expectations for interest rate cuts from 5 down to 4 over the course of the year. The hope of cuts being delivered by the March Bank of England Monetary Policy Committee meeting is now fading fast. In the US, year-on-year inflation numbers also came in higher, from 3.1% in November up to 3.4% in December. Here, as in the UK, services, which includes hospitality and tourism, remains an important, elevated contributor to inflation. This marks a shift from the dynamics we saw at the beginning of the ramp-up in inflation, where it was supply shocks and a rapid rescaling of demand for goods during the pandemic that was driving prices up. In the Eurozone, the year-over-year numbers remain stable at 3.9% in December. Regardless of the relative lack of movement in inflation numbers, in recent weeks we've seen some positive indicators from European Central Bank officials on the possibility of a rate cut in June. Here at Nutmeg, we focus not on the exact timing of central banks' pivots, but how much and how quickly those cuts will be delivered, and position our portfolios accordingly. With that in mind, we're still positive of equities, as rate cuts should be supportive of equity risk. In January, we cut our exposure to US Treasuries in favour of UK gilts, as we continue to see greater recession risk in the UK versus the US. We've also rotated out of European small caps into the US, as a weaker economic environment in Europe may act as a headwind against small cap equities. Finally, we've moved out of UK large caps and into Japan, as we see positive shifts in local demand and manufacturing production. We think there's an elevated risk that inflation could remain high, and that bringing it down to 2%, the target rate of most central banks, is unlikely to be smooth or plain sailing. We're also keeping an eye on climate change-related issues in the Panama Canal and the disruption in the Red Sea. Thanks for watching.